Good morning, everybody. Welcome to Friday. As always, it's exciting and uh, exciting to be here and to be able to talk about the market and how things are going with current rebel income positions. So we'll be getting right into that as soon as we can. Really quickly, for those of you who may be, good morning, Gib. Glad to see you. And those of you who are here live, welcome. As always, I'm excited for everybody who's here. For those of you who may be viewing this, and good morning, Barry. For those of you who may be looking at this for the first time, Rebel Income is an income generating investing system that focuses on identifying fundamentally strong stocks trading at deeply discounted prices that offer high value above their current price. We use those to generate income. These are also dividend paying stocks, which is one component of that income equation. But the other part is selling options against that stock. In the case of the first component of the income that we use is to sell put options against that stock as a way not only to generate income, but also to set up a possible purchase of the stock at a price that we believe represents a good value. And then we go from there. So the stocks that we talk about this morning, the positions and trades that we look at, are really going to be framed around the idea of not only what kind of setup they offered when the trade was placed, but also what do current market conditions mean for what you're going to do with that trade moving forward. Um, we'll discuss some of the different elements of trade management and talk about how current conditions and current events can play into the decision that you make about how to manage that trade. So that's with that said, a couple of other details here, just in terms of trying to facilitate the live stream. If you see if as we're going through this, you see something that you really like that we talk about, or a piece of information that really resonates with you. Couple of things. You can always react within the chat in the lower right hand corner. There's a little heart icon. Those are reactions, and you can put in different. You can click on different icons here, and it'll throw up some of those different reactions. That's a good way to kind of indicate how you feel about some of the things we're talking about as we go. It's also help the YouTube algorithm see engagement with what we're doing. If you like this live stream in general, please go ahead and click the like icon, and that also helps. This is also a live stream that I've the last several weeks have gone from making a exclusively available for paid members, and now I'm broadcasting this publicly. And so I want to try to expand the reach of Rebel Income as much as possible. You can help me with that by sharing this live stream with people that you know, that you think would benefit from the things that we talk about. I send out the notification for the live stream on Thursdays, and every eyeball helps. And so you feel free to share those links with anybody that you know. Barry, thank you. He says I invited a fellow trader and send him the link. I'm not sure if he's going to join, but that's exactly what I'm asking for. So I appreciate that so much. This is going to be a good way to try to expand the reach, not only for my purposes, but also want to build a community of people talking about their investments, comparing notes, not just simply following my trades, but let's talk about, as Barry and Gib are very familiar. This is really about trying to understand stocks based on not only what's going on in the market, but also as they relate to our individual preferences. I send out trading alerts to our paid memberships every week, and you can choose to follow those trades or not. I don't expect you to place the trade in exactly the same way. And so a lot of this, I'm going to be asking for participation from you to kind of get an idea about how you may have decided to apply the same, apply a trade to the same stock that I'm doing in maybe a different way, or what your respective opinion may be about something that we're looking at. Okay, so with that in mind, I appreciate everything that everybody does, and love having those of you that are here with me at this point. So let's go ahead and dive in. It is, as always, Friday. That means that um, there are options that are expiring. More to the point, it is the third Friday of October, so this is the normal expiration date for options, and so that means that there's a lot of activity going on today. We do have a number of positions that are set for expiry today, so we'll be looking at those. There's also a few that are coming up in the next few weeks, including this week's put sale on Conagra. We'll get into those as we move in deeper into it. But first of all, let's go ahead and start with the put sales that are on deck for expiry today, because depending on what happens with the market today, my normal method, whenever I place these trades, is to hold the trade through expiration and then I let the result be the result. That means that if the stock is below the strike price that I've sold, I will take an assignment. Now, these are American style options, and that means that if the stock has dropped dramatically below the strike price that I've sold, I could be assigned any point before expiration. But typically, more often than not, assignments don't happen until the day of. So we're going to look at those and see where they stand and talk about how that might impact some of the decisions that you make, not only about that trade, but also possibly other trades. Let's start with the first one, and that is on CTRA. This is an energy stock. No problem, Barry. Thank you. This is an energy stock that I've used in the past on a number of trades. I really, really like it at 24. That is the strike price that I sold on this one, and brought in 55 cents on it. This was a 1 month trade, bringing in a little over 2% on the trade. This was also a conservative position, and if you've been in this live stream before, you know that I really like to talk about position sizing. So I sold 2 contracts here. One options contract controls 100 shares. So that means that I'm in a position where I could be assigned 200 shares. Now, the way to determine how much of a position this may represent, I'm going to multiply the strike price by 200, the number of contracts times 100. And so that's going to tell me how much money I need to keep in reserve through the duration of the trade, all the way through expiration today. So I've had to keep that money in reserve for the last 30 days. In this case, 24 times 200, that's $4,800. Now, that's an important number because I need to keep that number available for the entire duration of the trade, either in cash, which is my preference, or through a combination of cash and margin if we're talking about a cash account. Now, my preference is to work on what's called a cash secured basis. That means that I don't want to have to rely on margin to fulfill the possible obligation that I am incurring by selling these options. So $4,800 in cash has to stay available in the account at all times while I hold this trade. So $4,800 divided by the total size of the account at the time, about 301,000, means that this is actually a very, very conservative position size of about 1.6%. My normal recommendation, even in really, really clearly bullish times and when I think there is plenty of upside in the market, is to be very conservative about the amount of exposure you are willing to take on in any one individual trade. And that means limiting your position size to no more than 3 to 5% under the best possible circumstances. For the last couple of years, I have been very, very careful about trying to stay between 2 and 3%. And more recently, have even shortened that again, even more in a lot of my trades, like CTRA, to being a little bit below 2%. Why is that? That's a function not necessarily of an attitude of bearishness about the market, but it is about understanding that I think the market is a little bit extended, overextended maybe. Here's the S&P 500, and I'm going to extend this chart out for a couple of years, and we can see that the market has increased from a low. Yikes, what is this? Around 3,400 back in November of 2022. That was roughly the low point of the bear market of 2022. And now we're pushing up around 6,600. In other words, the market has nearly doubled in the last 2 years. Now that's great if you're a growth trader, and boy, that sounds bullish. And in a lot of ways, it may be. It's also something that is pretty indicative that the market is a little bit overbought. And that is, it doesn't automatically mean that the market is due for a correction. It means that it is very possible. The risk is increasing. And when that happens, you want to be very, very careful about placing new trades. Okay. I'll be honest, I'm not exactly sure what that highlighted box, how that box came around. Gibbs says pretty scary. I'm not saying that this is scary. I am saying that the market is elevated. There is an increasing risk of seeing a pullback. Remember that corrections and pullbacks within trends are entirely normal. These are things like what we saw a couple of weeks ago. Things like what happened here in July. These are all pullbacks. This is a little bit of a correction. It temporarily even reached a bear market level. It just didn't sustain it for very long. Actually, this didn't reach bear market level. It reached correction territory, which is between 10 and 20%, but never actually dropped below 20. So these are actually very, very normal, and they're even healthy in the context of longer upward trends. They do represent potential cliffs where you may see stocks retreat in price. And so you do want to try to be aware of them. From a functional standpoint, that doesn't mean that I avoid placing trades, but it does mean that I start to look for opportunities to manage my risk a little bit more conservatively than normal. Okay. So CTRA, for context on this one, remember that I sold the $24 strike price, and as of now, we're sitting at $22.79. That does mean that unless the market rebounds up into this area, which is a pretty significant move compared to where the stock is now, I'm going to be taking an assignment. I do expect that. I'm also not afraid of it. As I mentioned, for me, the result is the result, and I'm going to pretty much live with it, whatever it may be. Let's try to see. Okay, that did make a difference. interesting. Just a moment. Okay, so let's take a look at the options on this one. Now, some people within our group take a little bit different approach to trying to manage these trades. I say that I let the result be the result. That means that if the stock is below the price that I sold at expiration, I accept that assignment. I treat these trades as an opportunity to acquire stocks that I really like at bargain prices. That's why the idea of buying CTRA at 24 doesn't really bother me, even though the stock is about $1.50 below that. I've already determined that this is a deeply discounted price that represents a nice entry point. But that said, you may not necessarily have the same opinion. There are a number of really, really good traders that I know that use put selling in a little bit different manner. They may place the same trade I did, but the objective may not necessarily be to take an assignment. In fact, they may prefer to actively avoid an assignment. And to be clear, if this is your preference, then you probably were looking to close this trade out sometime in the last week. So you probably were already out of this, which means that the numbers that I'm about to show you for comparison are probably a little bit skewed because we're on the day of expiration now with the stock $1.50 below. Now, keep in mind that when I placed my put selling trade, I brought in 55 cents per share. That was the total credit to my account for the contracts that I sold. I sold 2 contracts. The current asking price for the $24 strike is $1.35. Anytime you're working as a seller, you're always going to you're always going to sell to open. You're going to buy to close. If you decide that you don't want to just simply wait for the assignment or wait for the option to expire. So if you're of a mind that you don't want to take an assignment, you still have the rest of the market today, but you would have to buy this option back for $1.35. That means being willing to absorb a loss of 80 cents per share. In my case, excuse me a moment. If I cough, I apologize. I've been fighting a little bit of a bug this week. That means absorbing a loss of $1.60 per share or $160 for the 2 contracts that I sold. That's $160. That's a lot bigger than the 55 cents that I brought in. Maybe that sounds a little bit skewed. This is actually more about thinking about the total loss against the relative size of the account. Remember that the total potential obligation here is $4,800 for me. So if I divide 160, and this is getting a little bit messy, I apologize, but if I divide 160 by 4,800, I get a little bit better view of what this means. There we go. So that's taking about a little over a 3.3% loss on the individual position. That's actually pretty conservative. And for some people who prefer to manage these trades more actively, that may actually be a preferable result. Excuse me. Simply because this represents a way to minimize and manage loss by taking the assignment with the stock at its current price, now at 22.71. I'll immediately be looking at a paper loss, at least, of $1.30 per share, or for two contracts, $260. Now, that's not going to be realized because it'll be an open position, and I'm willing to wait and let the stock try to rally and come back. I do expect there to be pretty solid support around this low point. What just happened? Okay, that was interesting. I do expect there to be pretty solid support. I need to change my options here. Okay, interactive. There. Should be pretty solid support, right? In fact, this is just yesterday. There's a pretty solid pivot low right here in the 2250 range that lines up with this low in May. And so far, we are rallying a little bit above that. I expect that is going to provide some support for the stock. Whether or not it gives us an opportunity to get enough lift to get back up to 24 is an open question. But I do expect to see some consolidation, some stabilization around this level, just because there has been a lot of support activity between this and roughly 23 from July, August, and September in the past. And so I don't expect to see a ton of immediate downside here. That doesn't mean the stock couldn't drop further. It certainly could, but we can see a lot. There is a lot of support in this range going all the way back into 2024. That's part of the reason that being assigned to 24 doesn't bother me too much. Also, the fact that CTRA is a company that I like, and I think that the overall fundamentals are solid enough to support the stock as a very, very deeply discounted high value trade. This is a contrarian. Remember, when you're replacing these trades in stocks that are at the low end of a downward trend, we're talking about kind of a contrarian philosophy here. We're going against the grain of the rest of the market. That's because we're looking for opportunity where the rest of the market is discounting them and ignoring them. And that's usually going to be found in these stocks that are showing weakness. CTRA is a good example. So I'm going to take this assignment, all things being equal. But if you wanted to avoid that assignment, you've just seen one of the practical ways to do it. And that's by buying it back before the market closes. That immediately closes the obligation, releases what's left of those funds. You have to decide if you're going to be willing to absorb that net loss. Then that allows you to move on. No problem, Jay. Welcome. Glad to see you as always. Okay. So that is CTRA. The other stock, and again, if any of you want to throw out numbers for comparison as to what where you're at here, it does look like I'm going to take that assignment at 24, and then we'll see what happens. The next one is Skyworks. This is a tech stock. Placed this trade at the beginning of the month, selling the $75 strike price. This is another one that I've used a number of times in the past. I had a trade in September that went a couple of weeks at $72.50. This is a little bit higher strike price that I sold. To open October, brought in $1.80 on this for a 2-week trade, bringing in about 2.4%. This is, and I want to let me just go on, put the analysis on hold here, but I want to talk about why not just buy the stock outright? If I think that the stock is a bargain at 75 or CTRA at 24, why not just go ahead and buy the stock? Why do I want to sell an option first? Why do I want to sell a put option? Well, the put option opens the possibility of buying the stock. It also gives me a little bit more control over the price that I pay. Technically, CTRA was actually a little bit above 24 when I sold that put option. So if I were going to just buy it at the market at that time, I would have had to pay a higher price. Selling the put option allows me to set a price that I'm comfortable with. It also allows me to generate immediate income. This is income generation as a philosophy is all about really recognizing money that the rest of the market just kind of leaves, is not paying attention to. And it's really on this more often than not on the selling side of the equation. Growth focused investors, they just all they want to do is buy low and sell high. And that makes a certain kind of sense, but history has proven, a number of studies have proven, yeah, what's your ROI? Gib, I go along with that. History has also proven that the probabilities of success when you're simply trying to buy low and sell high, and that's the entire extent of your philosophy, your probabilities of success are low. You're going to be right. You're going to win maybe 25 to 30% of the time. And those of you who have been in this live stream before, you've heard me beat this drum before. That's a very low probability of success. It doesn't mean you can't be successful in the long term. I know a lot of growth focused investors that are successful. They do very, very well, but they also understand what the probabilities are of success on an individual trade. And it puts a really, really high premium on managing and minimizing losses on every single trade they make. And even harder on trying to maximize the gains on the winners that they have. It's a very, very hard way to try to make money. And I'll be honest with you, I don't believe that the majority of retail investors have either the resources, financial resources, time, or emotional discipline to do it. I will put myself right in that group, and I will tell you that I don't have the emotional discipline to do it consistently over time. I know how to do it. I also know that I have a really, really hard time managing my emotions successfully in these cases. So that means if that approach is going to make it harder to be successful, what do I do to try to find a method, an approach that makes it a little bit easier? And that's where I started to gravitate to the selling side of the equation. Because if buying is going to be wrong as much as 75 to 80% of the time, doesn't that mean that the sellers are probably right by a proportionate amount, reciprocal and proportionate? In other words, aren't they going to be right 75 to 80% of the time? And that's proven out, and then some in the trades that I've placed, and I've been tracking since 2014 when I first started publishing my Rebel Income trades. I'm bringing in a little bit of premium. That's the 55 cents that I brought in on CTRA, or the $1.80 that I brought in on Skyworks. If I just simply bought the stock outright, I wouldn't get that. That comes in as an immediate credit to the account. It's just money that's just waiting out there to be claimed. So I can bring that in, count that against my cost basis. If I do take an assignment, then actually my net cost in the stock isn't 75 in the case of Skyworks. It would actually be what is this, $73.20. Okay. So I'm able to set the actual purchase price at a level I'm comfortable with, and I give myself a little bit of extra cushion by bringing in a little bit of premium on the right up front. And this is also a premium that comes in as cash to my account. I don't have to wait for it. This isn't a hoped for kind of a profit. This is a credit that comes into my account right away. And so I can use that money for whatever else I want at that point. This gives me a really nice way to set up a potential entry into a stock I'm already willing to buy anyway. I would already want this to be part of my portfolio. And so that's why you hear me use the I'll use the phrase that put selling is a gateway to stock ownership. So for Skyworks, this is something that I've set up an opportunity here. If I am assigned, I'll buy the stock at $75. I generated about 2.4% in premium by bringing in the $1.80 on this. This is for a 2-week trade. Now, this is the other part of income generation that I think is powerful, is to understand what that 2.4% really means. That was a 16-day trade. So if I divide 365 days in a year by 16, it means, all things being equal, if I were able to place the same kind of trade every 16 days, I'd place roughly 22 trades. If every single one of those worked out the same way, I could multiply that 22 by 2.4. And there's your annualized potential result here. Now, this is an extremely simplified math. It doesn't quite work out this way because the results are variable. The time periods are variable. But what you're doing is setting up an income-based way to realize these returns over time. It may not sound all that impressive to maybe bring in 55 cents on one contract for a month. Woohoo, 55 cents, all right. Back in the 80s, that could pay for a really, really cool video, run at a video game. Excuse me. Apologize for the cough. That's what some people might think about the way that these premiums sound. But when you do these over and over and over again, you repeat the same method over time, what you develop is a compounding result. And so this is a really, really great example. Another analogy I use is to compare trading to baseball. Growth-focused investors are always trying to hit a home run. They're trying to double their money. They're trying to triple their money. They want some kind of a really big story that they can take to work or the next cocktail party or whatever it is, so they can impress all their friends with what a great trader they are. I don't care. If I'm a baseball player, instead of trying to hit a home run, I'm doing a lot of bunting. I'm taking a lot of walks. All I want to do is get on base. Kind of a money ball approach to trading is what income generation is really all about, and understanding what happens when I can get 2.4% every 2 weeks for an entire year over time. And that's how I've been able to build this account since 2014 from about $100,000 to now a little over 302. Is just by doing this again and again and again over time. So, okay. So for Skyworks, this is the setup. Yeah, Barry, today it's about home runs and strikeouts for the most part. Yes, that is what most people are doing. If you're going to swing for the fences, you're going to strike out a lot. That's the nature of growth-focused investing. You're either going to be very right or you're going to be very wrong. Think about home run sluggers in the major leagues. Major leagues, mind you, these are some of the best athletes and ball players in the world, right? Their batting averages are below 300. that means that they get out, strike out, pop up, whatever, ground out 70% of the time. Okay, so for Skyworks, let's take a look at where this one is now. With the stock at 75, the stock is a little bit below that point now at 74.18. That means that just like with CTRA, it looks like I'm going to be taking an assignment here. And I'm okay with that. This is a little bit of a different setup. And Barry, I see your comment. I'll get to that in just a minute because I want to highlight what you're saying there. This one's a little bit different than CTRA. Instead of being down by $1.50 or so, it's a little under $1. That means that this one may offer, if this stabilization and a little bit of upward surge in momentum continues, I might have an opportunity to, assuming I take the assignment on this today, I might also have an opportunity to sell a covered call fairly soon, possibly as early as next week, for the stock at maybe with the $76 strike price, or maybe something a little bit different. I don't know yet, but that offers an interesting opportunity. This is why I don't mind taking assignments. And it's also why, even though I show people, I like to highlight the opportunity to minimize losses by buying an option back before expiration, and why I support the people who may prefer to do that. It's also why I don't, to be totally honest. Okay, so here is the $75 contract that I'm working with. If I wanted to buy this back, I'd have to pay $2.95. Mind you, I brought in $1.80 on this one when I sold the put option. So buying it back for $2.95 means absorbing, and I only sold one contract in this case because of the higher strike price. So I would have to be willing to absorb a loss of $1.15 or $115. That's if you wanted to manage, if you wanted to try to manage the loss. Again, that's not necessarily wrong. It's just a little bit different method. But what this also does is it sets up the opportunity by taking the assignment at 75 with the stock showing some stabilization. It's now gone a little bit below 74, but it's not far away from 75. That may offer an opportunity to sell a covered call. Here's 75. Here's a covered call for a little bit about a month out at 340 right now. That's not terrible. That's interesting, in fact. 77.50, 245. Also interesting. So, Barry, in trading, it's sometimes about timing. You may be correct, but off by a week when you have a designated time period for buying calls and puts. And that's exactly right. This is, I just talked about growth-focused investing, the simple buy low, sell high method being wrong 75% of the time. When you do that with options, you also have to factor in the element of time decay, which means you have to be right in the time that you have. If you bought 3 months, you have 3 months for the stock to move the way that you want. A lot of traders make the mistake of buying as little time as they have to so they don't have to put a lot of money into the trade. Well, that actually decreases your odds of success. If you buy an option that is 4 weeks from expiration, which is why I'm selling them, by the way, there's a great likelihood the stock's not going to move enough for you to make the money that you intended. That's why if you're buying options, your probabilities of success may be even below 20 to 25%. So Barry, you're exactly right. You got to be right at the right time when you're working with options, and that makes it even harder. Well, time decay is an asset, is a Time decay is a risk element for a buyer, but it's an asset for a seller. And so that is something that means that not only are the premiums available from selling options like low hanging fruit, right? It's just money that the market is leaving out there. It also means that it's time as the expiration date comes closer and closer, time decay accelerates and continues to work more in favor of the seller than for the buyer. So I love that comment. Thank you. Okay. So this is an interesting one. It does mean that I'm going to, in all likelihood, take an assignment here. I don't expect, given the way that the stock's momentum is going, we're not seeing enough activity to drive the stock up above 75. I could be wrong. There's still the rest of the day for the market to move, so it could still finish above 75. But I'm going to let this expire, and I'm going to let, again, the result be the result. So we'll see where this lands. But that's Skyworks. All right. Let's take a look at the last one on deck for today, and that is a covered call on Schlumberger. This is a stock that I've held for a little while. I was assigned back at the end of August at $35, and I sold the $36 strike price covered call. Now, this one means that the stock, when I was able to sell this option, the stock was pretty close to my original $35 strike price. I was able to bring in 75 cents or 2%, 70 cents, excuse me, or about 2% compared to the $35 strike price. I only own 100 shares on this, so I sold one contract on this one. This was a 2-week trade. So 2% for 2 weeks of time, that's a nice result. When you combine that with previous covered calls that I was able to place on Schlumberger here, 81 cents, here's 67 cents here, as well as the original put sell where I brought in 65 cents. Overall, I've done pretty well with this, and also been able to bring in a little bit of extra income from dividend distributions. So that's been useful. But this covered call gives me an opportunity. If I am called out, I'm going to be called out at 36. That's $1 above the strike price that I sold. So I've got the opportunity to bake in a little bit of extra gain on top of the income that I've already generated. Okay. So my assignment price on this is up here at 35, and we can see the stock down at 32.50. It's really going to have to see a lot of momentum to the upside for me to be called out. The 36 is up here, even higher. So it's got to get all the way above this for me to be called out. Very, very unlikely. So it looks like I'm going to hold on to my shares for a little bit longer, but I'm okay with that. Here was a 28-cent distribution from dividends at the beginning of September. There'll be another one coming up towards the end of the year, and so I'm willing to wait for that. That's totally fine, and I'll just wait for the stock to pick up a little bit more momentum. At some point, it'll be back up here around 35, and give me another opportunity to sell another covered call. Again, I want to go back to the repeated opportunities that I've had to place trades here with Schlumberger and to generate premiums. Talk about picking up the low-hanging fruit in the market. Barry, my last opportunity for a call was last month, waiting it out for now. Yeah, with the stock now a little bit below, then that changes it changes the opportunity a little bit, right? And you may need to be patient as opposed to actively selling options. But here's my first put sell, that's 65 cents. Move this so I can see my symbols more clearly. Then my next one was 67 cents. Then 81. Plus the 70 cents for the latest. Okay. I've been able to generate $2.83 in premiums on this stock since I was assigned, since my original put sale and since I was assigned at 35. That also means that my net cost in this is not $35. Means my net cost here is $32.17. Barry, you're in at 36. Okay. 32.17 with as a net cost is actually really, really nice, because that means that I can gives me a lot of flexibility between now and 35, or now and 36 in Barry's case. Makes it a lot easier to think about what's practical and what my real risk here is. At this point, it's really, really very low. Even with the stock showing the kind of momentum it is right now, I'm actually still at a net positive result. So that's really, really interesting. We just had a brand new earnings report come out today, and so far it looks like the market is selling off a little bit from it. We'll see if that continues. The last few reports have really not given the stock a lot of momentum to the upside or the downside. So Barry's brought in $1.66 on 3 calls since. So Barry's net cost in this 36 minus $1.66, 34.34. Again, that makes it pretty easy to start. That changes the evaluation a little bit, and makes it a little bit easier to manage the emotion attached to price action. It's very, very natural to look at big drops and try to have an emotional reaction to them. But when you can run the numbers the way that we're talking about, it allows you to put them in a little bit different perspective. So this is okay. I'm not too afraid of this. The stock is still holding in a mostly sideways pattern all the way since May. And by the way, this is actually really, these kinds of sideways patterns are really useful for income generation. And the trades that I've outlined are a really good example of that. So Barry brought in 75 cents on the initial put sell. So awesome. All right. Let's take a look here at some of the other ones that are coming up on next week. Is the put sale on Nike. This was last week's put selling trade. I sold the $68 strike price on this one, bringing in a little over 2% for 2 weeks. So let's check out where that one's at. Again, I sold the 68. So we're a little bit below that point. Yep. A little bit below that. The stock looks like it's trying to stabilize a little bit today, but yesterday was a pretty hard down day. We do also have some downward trends working against the stock. Here's a short-term downward trend, along with this longer downward trend reflected by the blue line. That's my 200-day moving average. So both of those are working against the stock. That could keep it below 68. but it's right around that range now. Now, if these trends are a concern to you, if there's something that you think represents an increasing amount of risk, and this is a stock, to be clear, that's in a downward trend that goes all the way back to 2022. Downside could be all the way down here around 52. It's where the stock bottomed in April. So there could be some risk of additional downside here. If you're in on this trade as I am, maybe that makes a case for trying to close out the trade a week before expiration. You certainly don't have to wait until the day of expiration to decide what to do with any of these positions. Here's next week's expiration. Here's the 68. Again, on this one, I brought in $1.40. Here's the 68. If I, excuse me, if I didn't like the direction of those trends and I wanted to try to manage and minimize my risk with a week left to expiration on this, I could buy to close this option back for $1.85. I sold one contract on this one, so that means absorbing a loss of just 45 cents or $45. That's not bad. Again, if you're trying to manage your trades a little bit more actively than I am, that's okay. That would take the $6,800 that I put in reserve minus 45, give them back to me right now, and then I could redeploy the money back into another trade. Maybe I like better. Maybe I want to go a little bit lower with go to a little bit lower strike price with Nike. Maybe I want to work with a different stock. But those aren't bad choices. Again, I really like Nike at $68. It's a good value. The value proposition is there. It's much higher. It's very well above $68. So I don't mind taking the assignment if I do, if the stock stays below this level. So we'll see where it is next week. But this would be a way to think about possibly managing that potential downside if you're using put selling as a little bit more of a momentum method. Then that's okay. Barry has a $45 on MGA. So Magna International. This was another stock that I've used quite a bit in the past. Let's go ahead and take a look at that one. I appreciate you sharing this, by the way, Barry. Pulling back pretty sharply to start October. 47.50 call. So that's right around here. 47.50 for $1.02 on the downward trend this week. Bought it back for 10 cents and then sold a $45 call for 20 cents on Tuesday. So, okay. I'm going to assume, Barry, you can correct me if I'm wrong, that the $45 call that you sold, okay, I'm going to assume that also expires today. He's in it at 42.50, so he's got a net positive result. Still going now, and premium here initially brought in $1.02. Bought it back for 10 cents. And then sold another call for 20 cents. That looks like it was also going to expire today as well. So he's got $1.12 net income result here based on that 42.50 entry price. That's not bad. Where's my calculator? There we go. So 2.63%. Yeah. Outside of a rally, be washing and repeating. Yeah. And that's kind of one of the nice things that we get to do with covered calls and stocks that we own. For me, Schlumberger was a good example. And for Barry, thank you for sharing this. MGA is a great example. When you own these stocks, you get opportunities to, what I like to say, lather, rinse, and repeat. Because if you're closing these out the way that Barry did with the first covered call, if you let these, if they simply expire worthless, but the stock is still in a good position for you, you get repeated opportunities to do this. So you just get to keep the income generation going again and again and again. And that's it's one of the reasons, even when I do take assignments, the vast majority of the time, more than 90% of the time, in fact, by the time I do get finally called out of the stock, I will usually have a result that is a lot more than just the one put sell premium I brought in and the one covered call premium from the call that calls me out. I usually end up having at least 2 or 3 of those different different income generating trades along the way. So that's awesome. So Barry, thank you for sharing that. I appreciate it. That's a really nice result. Barry's not normally that active, but the opportunity arose to net 10 cents for a 3-day trade with the buyback and resell. Yeah. Why not? Why not? Again, that was money that was just laying there waiting to be picked up. I love it when I love when people start to recognize that and start to see the opportunity that represents. So, yeah, you are still sitting at a nice capital gain. If it continues to show any stabilization here, and this is a really, let's be clear, as severe as this decline looks, again, it's really just a pullback within the longer upward trend. And this is starting to build a nice bullish upward trend, even from the 200-day moving average. So, yeah. And if it continues to pull back, then there may be another opportunity to sell another covered call around 42.50, maybe 45. Who knows? I don't know. This is a stock that had been in a downward trend for a while, but is starting to show some signs of reversing that trend. This one goes all the way back to 2021. But I think that it's starting to reverse that in a meaningful way. So that's useful. Okay. Well, everybody, that is pretty much where we're at time. So we're going to have to go ahead and call it at this point. But I certainly appreciate everybody who has attended today. I appreciate your participation as always. I hope that you have a wonderful weekend. If there are any questions that come up between now and next Friday, please don't hesitate to reach out and let me know. Email address is rebelincomesystem@gmail.com. You can also reach out to me on Substack or on Discord, whatever platform you're on, and I'll respond to you there as well. Thanks again, everybody. Talk to you next week. Barry, there we do have the Holy War tomorrow, in fact. So it's going to be interesting. Yep. Thanks again. See ya.